Today's guest is Mike Dougan. He's a managing member of Independent Business Valuations and Appraisals, or IBVA, in Castle Rock, Colorado. Thank you to Zarlingo Robb, CPAs and Business Advisors in Wheat Ridge, Colorado, for providing a location for us to film this episode. At Zarlingo Robb, they think like business owners. For more information about Zarlingo Robb, please click their link in our website show notes. Hi, I'm Norman A. Hood, financial advisor and host of the Exit Plan Show. I interview America's top advisors, like today's guest, Mike Dougan, to help business owners like you enjoy more personal freedom, grow your company faster, and transfer ownership seamlessly when the time comes. Like I said, Mike Dougan is our guest today. He's from Castle Rock, Colorado. He's with IBVA, and he's a qualified appraisal expert. Mike's completed assignments for federal gift taxes, estate taxes, income taxes, stock options, divorce, mergers and acquisitions, and exit planning. Thanks for coming back again, Mike.
Sure.
We're going to talk about business valuation costs and benefits. So the number one question I bet a lot of people are asking, what's a business valuation usually cost?
Well, the typical answer is it depends.
Yeah.
Once we establish what the scope and the intended use is, and whether or not we're going to have to defend this value, say in court or with the IRS or Treasury or those types of venues, there's a lot more involved in the production or the report as a whole. If the client's using it for planning purposes, such as exit planning, or they're trying to determine how much insurance they need, or they want to establish a bench line for buy-sell agreements that they're putting in place, those types of things, then we can scale down the report to a restricted report and then do that. Cost-wise, I work on a fee basis that's set on the actual project itself. I do not bill by the hour unless I'm doing expert witness, and then it's a minimum and X dollars per hour. Most of the time, I see it as, what's the business and size, and what can they afford. I try to set a number and then give the client an opportunity to tell them what's in their budget. Of course, at that point, I tell them, no, I'm not going to do it for that.
Not my budget.
Right. But, to give the numbers, if it's for planning, it starts around $2,000, and then it'll go all the way up to $20,000-$30,000. But we're talking about multi-50 million, $75 million businesses.
Well, for a buy-sell agreement, I mean, that's pretty important. You have the right number, because you're sometimes talking about selling, your share of the business, which could be $1 million, and you might want to get the number right before you.
Well, yes, or give you an idea of what it is. A lot of the new buy-sell agreements are coming out where they'll just state that the trigger event should happen, an appraisal will be performed under the fair market value standard, and really not put a formula into the wording of the buy-sell agreement, which is really a good thing to protect the parties, because history tells us that once these are in place, they very seldom go back to revisit them.
Yeah.
And then that trigger event happens, and all of a sudden, they've got a formula there that is no longer applicable to their business, and it makes it very difficult.
Yeah, if they got insurance in place, they don't have the right amount.
Right.
Usually they probably don't have enough.
Yeah.
Especially the business grows.
Yeah.
How often does the owner's perception of what their company is worth match the one you come up with when you're finished with the valuation?
Almost never. Almost never. And there's a lot of reasons for that, because as we talked earlier, there's a difference between value and price. And the perceived value that the owners have is usually based on a price that they've heard somebody sold a business for, or they read somewhere that a multiple of earnings of some definition was X, and so they've put two to two together. And there's always that emotional side, the pride of ownership. They always feel Normally my business is better than anybody's else, so I should be getting more.
Right.
And that mentality's out there, and that's good. I mean, they need that, but at the same time, depending on what the valuation is for, we may be trying to establish a lowest defensible value for that owner, for tax purposes and internal family transitions and those types of things. Whereas if they have a transaction going on with a third party, maybe we need to look at an investment value and get closer to maybe their perception of value. There's two sides to this thing all the time. There's a buyer side, which most of us think of, well, what's that hypothetical buyer going to do? But there's also that seller side. Would a hypothetical seller be motivated to transact? And then a lot of times that gets missed.
Yeah, okay.
And so we have to look at it both ways, give and take, and say, hey, out there in the real world, what's going on?
Yeah, good. So, yeah, that's new information to me. I'm glad you brought that up. I'm sure it's new information to a lot of people listening to.
Right, I imagine so.
From my end of it, I hear business valuations talked about a lot for exit planning, and you've hit some of the other reasons you use them. Any other reasons you can think of a person would want a valuation besides what we've already talked about?
Sure. There's a long list of them, and they keep expanding. One is our government and the requirements that are coming out where they want to keep tabs on everything, but financial reporting, that's a big part of the segment, and that's where your accounting firms get involved a great deal. But your divorce situations, shareholder disputes, the exit planning, the estate planning, gifting, all of these have to have a valuation provided by a qualified appraiser. Even SBA loans, and to go to my machinery and equipment side, when the banks do loans, they need to know what their collateral is worth. Not only what is the fair market value, but what is the orderly liquidation value.
Oh, okay.
So, those all kind of interlap. When I look at a balance sheet on a business, and it's been in operating for 30 years, a lot of their assets have been depreciated out. Yet they still have the value because they are a part of that going concern. There's another place that machinery and equipment value has to be plugged back in at fair market value. So, lots of reasons.
Yeah, I can imagine.
Yeah.
Okay, thank you. At the end of this video, we'll show you how to subscribe to our free newsletter, download free guides, and have an opportunity to win free books from Amazon.